Hello, it's ChewDog Charts. Now, how do we know we're in a bubble? Heck, for that matter, how do we know the two previous widely acknowledged bubbles were bubbles? Was the late 90s run-up in the dot-com stocks a bubble? Was a run-up in real estate prices in the middle of the last decade a bubble? The economic conditions that prevailed during these two episodes were very different, so it is easy to dismiss the idea that they have a common cause. The earlier period featured a strong dollar, rapid productivity growth, and falling commodity prices. The second time featured a falling dollar, lousy productivity growth, and booming commodities. But both featured what we have all come to realize were pretty obvious asset bubbles in technology stocks and real estate. How could monetary policy be the cause if the economic conditions and bubble assets were so much different? But those economic conditions and the two very different bubble assets do point to a common cause, and the answer is actually revealed, in some ways, by the current bubble. The Fed's position on bubbles is that you never know one existed until after it has burst and caused widespread financial and economic damage. And since you can't know when one is forming, the Fed can't do anything about them except for try to clean up the aftermath. True, there are no agreed upon parameters that define a bubble, and the concept is relatively foreign to economists. And although economists may not know how to define a bubble, I know one when I see it. And to me, today's stock market is a bubble second to none. Let's take a look. And this chart here is the household wealth to income ratio, which goes back to 1950. And in the lower left, you can see the dashed line. The 45-year average is 4.9 times the household wealth to income ratio. Now, that ratio increased from a level of about 5 up to above 6 in the late 1990s during Alan Greenspan's tenure, right before the crash or the dot-com crash, where the household wealth to income ratio fell to under 5.5, but still above the overall 45-year average. And then during Ben Bernanke's tenure, the household wealth to income ratio increased to near 6.5 before the great financial crisis, when the household wealth to income ratio dropped to nearly 5, still above the 45-year average. And now we have Janet Yellen, where the current record high is at 6.50. So the question becomes, if we are at a peak and we do turn and fall once again, even if we fall to the 45-year average of 4.9, that's going to be a relatively catastrophic decline. So let's go to the next chart. And this chart here from the University of Michigan, which shows the level of bullishness. Now, the stock market's had its best start since I can't remember when, but it's being driven by two things: upward earnings revisions and the crush of money flowing into stocks. And the optimism is shared not only by the institutions, but also the mom and pop investors alike. And the survey shows that a record 66% of Americans believe that the stock market will climb in the next year. And that's an all-time high record. Again, second to none. Now, what's important is go back to the 2007-2008 timeframe and take a look at that point, and we had reached at that time also a record high right before the great financial crisis. In 2015, we reached another interim high. We did have a downturn, but we're back up to, again, the level of 66, all-time high. Let's move to the next chart. And this table here is the S&P 500 aggregate index and median stocks, showing both highly valued on most metrics. The first three columns are the aggregate index, and the second three columns are the median stocks. And looking particularly at the median stock tables, we show that the equity value to sales in the first row there is in the 99th percentile. And then the equity value to EBITDA is also in the 99th percentile. The forward PE is in the 96th percentile. The PE to growth, or the PEG, is at 100. The cash flow yield is in the 96th percentile, and the price to book is in the 99th percentile. Now, I can't say that these all are at record highs, second to none. However, those are impressive scores no matter which way you look at it, and I only wish I could have those scores when I was in school. Let's go chart. And this chart here, which is the CAPE ratio, but it's been adjusted for profit margin and GDP, gross domestic product. The CAPE ratio is a valuation measure that uses real earnings per share over a 10-year period to smooth out fluctuations in corporate profits that occur over different periods of a business cycle. And it's, again, been adjusted also for margin and GDP also to smooth out those fluctuations. And the CAPE ratio is generally applied to an index such as the S&P 500 to assess whether the market is undervalued or overvalued. And you can see the current level is 3.63, and that means that we're over 360% above the mean. So stock investors are currently paying significantly more for a unit of economic growth, more than any other time in the last 70 years. And although the chart only goes back to 1954, they have given an estimate for the peak in 1929. You can see that in the middle toward the left, and the peak in 1929 was 2.68. And you can also see that the peak there in 1999 was 1.91. So we're significantly higher than any other level. Again, we're at a record high, second to none. Let's go to the next. And this chart here is showing the number of days that the stock market has been going up without a 5% correction or more. In the chart, you see that the current level is 395 days. However, this chart's probably a few days old, so we're actually over 400 days since a 5% correction or more. And this goes back to 1929, and as you can see, that the average from 1929 to today is slightly under 100 days. Therefore, we're at 4 times that level without a 5% correction or more. Now, this isn't going to say that we're going to have a stock market crash, but we should be expecting a correction of about 5% or more. But once again, we're at a record high, second to none. And this chart here is the 20-year monthly chart on the Dow Jones Industrial Average ETF, the diamonds, or the symbol DIA. And as we look here in the price chart and then move down into all these other oscillators such as the MACD histogram, the momentum indicator, and the price rate of change, all of these oscillators are extremely impressive. And we come to the relative strength index, which has a current value of 96.46. And I've shown or drawn this horizontal bar to show you that we've not been this high, at least through the period of this chart. And the only other times that we have approached this level were back here in the 1999-2000 timeframe, right before the dot-com crash, here in 2007, right before the great financial crisis. And then, of course, we're at this level here today. Now, I'm not implying that we're about to have another financial crisis. However, the probability does remain. So we need to be cautious. And if you're going to go out and buy some stocks, you just need to make sure that the odds of success are in your favor. Currently, in many stocks, the odds are not in your favor, and that's why we continue to look for cheap stocks. So be patient, stack your cash. because today's market is significantly high, and in my opinion, it's so high that it's second to none. So for today, that's ChewDog Charts. Thank you.